But before I get started, I do want to tell you really how I got to be where I am today. And I think it'll hopefully help you understand why I do what I do and why I'm so passionate about what I do, because it's really a lot of fun, I will tell you. So about 25 years ago, I was sitting in my daughter's room. Some of you in this room know who that is, but this is way back when she was an infant. It was about 3:00 in the morning. I was doing her middle of the night feeding. I was working at Deloitte at the time. So it was the only time I could spend any really quality time with her. It was about 2 or 3 in the morning, which says a lot about my life at that time, right? I was working so much that was my quality time with my new daughter. Everybody in the house was sleeping. My son was sleeping. My wife was sleeping. Her and I would be sitting in the little rocking chair in her room. And it was a really cool time, except one night it really kind of started to change for me because I started thinking about what I just said. Wait a minute. This is 3 in the morning, and this is my quality time with my daughter. And that kind of stressed me out, right? I kept thinking about everything that I wanted for our life, our family's life, how much more time I wanted to spend with her. And I started thinking, man, at this rate, I'm never going to be able to see her play her basketball games, her football games, my son's baseball games. I just couldn't see a path where I was going to, based on where I was headed, put my kids through school without taking on a ton of debt. It just didn't seem to be heading in the right direction. You see, I was frustrated, really frustrated, because I thought I did everything right. Here I was, I got my undergrad from Toledo, I got my graduate degree from Case Western Reserve, I was a lender for a while, now I'm a CPA, I'm like, man, I am rocking, right? Just like a lot of you are obviously very successful people if you're investing in our real estate deals. So I was frustrated, I just couldn't save much money, I couldn't figure out how I was going to get a path to where I wanted to go. I did have a little bit of money saved, not very much. And unfortunately, every time I tried to invest it in the stock market, that never went well for me. And none of those investments had any real cash flow. So obviously I was really frustrated. I will tell you that it was at that moment I decided, you know what, I got to figure something else out. I got to make a change. This is not what I want for myself. And it was really disappointing because I had spent so much time and energy getting myself to that point. So up until that point, I dabbled a little bit in real estate, and I knew a little bit about it, but not really very much. The only property I bought, I thought it was going to be my retirement. That's how clueless I was in this business. So I spent a whole lot of time and a whole lot of money. And remember, back in the 90s, information wasn't everywhere about how to do this real estate thing. So I went to apartment association meetings, and it was a painful process. But I will tell you that over the next couple of years, I was able to buy a total of 3 properties. And 3 years later, I'll never forget it. It was the year 2000. I think it was November. I think. I sold those properties. Now, remember, I'm still working at Deloitte at the time, so I really did this on the side. But when I sold those properties, I made $500,000 on the side while I was a CPA in real estate. So for the first time in my life, I had $500,000 in my bank account. Never imagined that was possible. I mean, it just blew my mind. So at that point, I figured it out. Now I know I was going to put my kids through school without racking up a ton of debt. I thought, wait a minute, if I focus on this instead of working so much as a CPA, I can probably get the life that I wanted, right? I didn't have to worry about the stock market, right? I don't need it. I can invest in real estate. So I not only had a plan, but I had a plan that I knew was going to work. And that was huge for me. I felt like, wow, this is unbelievable what the last 3 years had done to my life. Because remember, I was in my late 20s, early 30s then. Fast forward, I'm thrilled to report that I have done all the things that I set out to do. My kids have gone to school. We didn't rack up any student debt. I'm now 100% in charge of every single day of my life. And I'm not worried about what might happen to me as a CPA. And I'm also proud to report that over the last 25 years, we've helped hundreds of people, just like many of the people in this room, create massive wealth investing in real estate. Now, thanks for listening to that story. It is so important for me because I hope it helps you understand why I'm so passionate about what I do, how we do it, and the impact that it's had not only on my life, but my family's life and the lives of of our investors, many of which are in this room. So hopefully you're ready now for me to give you the real deal. And, when I named this little webinar, we're going to do this every month. I'm going to try to give you the real deal. It's not going to be filled with hype. It's going to be what's really happening on the ground every day, and it's going to be real data. So let me start off here by sharing my screen. 4 things that I promised to answer when I sent out the email for this thing. I want to make sure that we get through these, so I want to make sure we talk about them here tonight. Why higher cap rates and interest rate are actually good for you as an investor. I know people are shaking their head about that one. Why almost no one is selling right now, and why I think, or when I think they'll sell. Why some properties are performing really well right now, and why some aren't. And finally, should you invest now or should you wait? All right, let's go back. We're not going to spend a lot of time reviewing the basics of real estate, but I just want to remind you why we do this. The benefits of investing in real estate, especially because some of you are new. Number 1, it's cash flow. Number 2, it's appreciation. And number 3, it's tax benefits. So cash flow, it's very simple. We have lots of different tenants paying us rent. All those people work for different people. They have different employers that are in different industries. So we get a great diversified income stream. In our business, every month, the expenses are fairly predictable. So what that means is, as long as you get the management right, the revenue should exceed the expenses, which means you're going to have excess cash flow, and that cash flow is paid to you as the owner. That's how the cash flow comes into it. It is not the biggest reason you're doing this, but it is an important part of why you would do this. The real reason we do this is the appreciation. So everybody knows or believes that real estate appreciates over time, and it does. But with multifamily, it's why that happens that is so important and so big part of why we make money. See, real estate in our world appreciates over time because the cash flow increases over time. It is predictable, generally speaking, that if I'm able to generate more cash out of an asset, somebody's going to be willing to pay me more because that cash flow is higher than it was when I bought it. Our value add business plan is designed to increase cash flow, and not just by a little, but by a lot, right? That results in incredible appreciation generally, and that's the reason we do this. The appreciation is massive in our world. Now, the icing on the cake, if you've heard me talk for a while, you'll know I tell you, don't let the tax tail wag the dog, but this tax tail is not a bad one to have. In our world, it's one of the few investments left that are tax advantaged. The cash flow is not taxed currently when you receive it. It's because in our world, you get a K1, and that means we get to book depreciation deductions that basically zeroes out that cash flow income, and even though that asset is appreciating in value. So get that. The IRS lets you write off the cost of that real estate over a period of time, even though the asset is not going down in value, but going up in value. So that's a good thing. So that means when the cash flow comes to you, you have actual deductions to offset that. It's possible that these tax losses may flow through to your personal return. And even if they don't, when we sell these assets, capital gains tax is generally what's generated, and the capital gains rates are usually at least not much more than half of the ordinary income tax rate. So I think it was really important that I go back here to the basics so that you understand. Now, before I get into, remember I told you we're going to do the real deal here, right? I'm going to tell you what's really going on here at KRI. I forgot to announce, I am really proud that Max has helped me, and we have really been able to expand our reach here tonight. You don't realize this, but we are now live streaming this event on Facebook, LinkedIn, YouTube, and Twitter. So it's a new chapter in our history, and we're super excited to be able to do that. And obviously, the technology allows us to do that, and that's super excited. So I just wanted to announce that so that y'all knew that. All right, where does KRI stand today? Up to this point in time, we've done $130 million in investments. We've raised $34 million from outside partners. That doesn't include my investments. We have a total of about 240, they're all numbers are approximate, 240 investors in our deals. We are super proud of that number. Last year, we distributed almost $700,000. In this year, it is our goal to distribute more than $1.25 million. And so I'm super proud of the progress that we're making. We own or manage about 1,750 units, kind of keeps our people busy on the ground. So our last 3 deals that we've turned, for some of you, this will be repeat information, but a lot of you are new, so I want to make sure I share it. This is the real deal. This is on the ground. We recently turned this deal, Coachman Club Apartments, 72 units. It was Clearwater, Florida. We bought it for about $6 million. We sold it about 2.5 years later for a little over $8 million. Here's the key. We were able to move rents from $785 to over $1,100 a month. That movement in cash flow was able to generate our investors an annual return of 30% over that 2.5-year period. That's their return, not gross return. That's what they got for their own self. That means if they invested $100,000 in that 2.5-year period, we returned to them a total of $175,000. Second to the last deal that we liquidated, we sold, just coming out of the pandemic, Bell Reef Club, 104 units in Jacksonville. If any of you have been on our YouTube channel, and I would encourage you to go there because I'm putting a lot of stuff on there, but this one is called the Jacksonville Turnaround Story. That whole 20-minute video narration is about this deal. I give you awesome before pictures, after pictures. You can see exactly what we did, exactly why we did it, right down to why we painted the fence, the color that we painted it. So you kind of got in the weeds a little bit, but I think it helps you understand why we're so successful. We bought that deal for about $7.5 million, sold it 3.5 years later for a little over 13, and we moved rents there from $750 to $9.25. Our investors' annual ROI was about 22%. That means over that 3.5-year period, if they put in 100, they got back about 177,000. All right, the last one we sold, this is the last full cycle deal. We haven't sold anything since this one. Whispering Oaks Apartments, 75 units, teeny weeny town in Florida called Orange City. It's about maybe a half hour northeast of Orlando, right off I-4. Townhome style property, as you can see. I love townhomes. Most of you know that. It's just such a great place for people to live because a lot of people don't want to be apartment dwellers. And when you're in a townhome, you don't feel like you are. We bought it for $5 million, sold it 2 years later, actually 2 years in a month. Sold it for $8 million. We moved rent from $700 to $850 there. Our investors' return annually was 36%. Again, put in 100, you got back $172,000 on that deal. Our last fund, we have not turned these deals yet. We have acquired these assets. We're currently managing these. So in our last fund, we deployed about $16.5 million. We bought 84 units in Tallahassee for a little under $11 million. That thing is screaming right now. Our income has increased by more than $28,000 a month. I'm super excited to tell you that. 234 units in Bradenton for about $41.5 million. We are currently getting projected rents plus $100. That property, and I'll share a little bit later with you, it continues to just do amazing. And then 55 units in Daytona, Florida, a little over $8 million, and we are also beating our projected rents there. As I alluded to before, this, by the way, is the picture of our clubhouse in Tallahassee. Just such a cool picture, I think. Last quarter, we distributed $300,000. Next quarter, we plan to do the same. I think I've kind of already talked about that a little bit. Part of the reason we're here is to talk about our current fund. We're going to get to the really good stuff here in a second, but our current fund looks very much like our last fund. We're in our capital raising process. It's going very well. When we do our funds and when we do our underwriting, we're looking for at least 15% annual rate of return to our investors. That's our target. I mean, there's not a guarantee there, but that's our target. Some of that return comes from preferred return, and some of it comes from the appreciation that you get with the asset. So in our world, if you're an investor with us, you get a preferred return of 6%, you get all your capital back, and then we get to an 80-20 split on the profits. A couple other benefits here, a couple other just useful pieces of information about our funds. If you're in our fund and we get another deal on the side, or we need extra money to finish the deal like we did in Bradenton, you get first right of refusal on any additional investments, and it's typically at the same exact terms. It's going to depend on the deal, but if I can hold the terms exactly the same as the fund, then I try to do that. You need $100,000 minimum investment. Target hold period for each property is about 3 to 5 years. And we are targeting growth markets. That's all we look at. If it's not a growth market, we're really not going to look at it, because we spent the first 10 years of our life in a non-growth market, and it's a lot of work. Trust me on that. All right, the fees at the bottom, they're 1% acquisition, 1% disposition, and a 1.5% asset management fee. I think you'll find those fees are probably some of the lowest in the market. Now, I'm not going to go into a huge discussion about funds versus syndications, because I really want to get to some good stuff here for you. But I just want to make sure you know why we are still using the fund model. Our last fund proved it to us that buyers or sellers love buyers with money. It gave us a massive buying advantage. It gave us much better deals than we would have gotten if we were just syndicating each one of those deals. That Tallahassee deal never saw the market, and the Bradenton and Daytona deal, we were not the highest bidders. I can tell you that. So I'm super proud that this structure, this fact that we already have the money raised, sellers notice that, and they want to close their deal, so they'll give us the deal. Something that gets a lot of confusion to people, when you commit with our fund, you're not writing me a check on the day you commit. You're going to wait until I find the deal, and then I'll call the capital. And you just send in part of the capital that we need to close that particular deal. What's important here is that you can keep your money invested in whatever it is you're invested in until I call that capital. And for the many of you are on this call, I know are committed to our second fund. All I need you to do is just be patient, stay invested. We're working really hard to find deals. We're going to talk a lot about what's going on in this market tonight, so that you understand why it's a challenge to find these deals. And a couple more benefits here. I mean, if you looked at the last fund, there were 3 assets in that fund, one in Tallahassee, Bradenton, Daytona. Those are massively different markets, massively different building types. So you're getting a lot of great diversification inside that fund from geographical locations and things like that. Finally, lower transaction costs are important, because we only had to raise the money one time, right? We didn't have to go out 3 different times and raise money. So you benefit that, right? Because those expenses typically come out of the investor's returns. And then finally, sponsors always get paid last. We do that on our syndications, but in a fund environment, this is an interesting thing, unless I point it out, most people don't realize it. In a fund environment, I have to return all of the capital that you've invested in the entire fund. So then that last example, that whole $16.6 million has to be returned. You have to have gotten your preferred return on all of that. And only then do we get to the 80-20 split. So that is a truly backloaded business model. And I think that's really important, that we put you first, and that's how we do that. Max, we doing okay?
Doing good.
You are? All right, let's get into the real deal here. So before you can understand what's happening today on the market, I got to spend a minute just talking about the last couple of years. And I'm going to try to put this into a story form that is digestible and doesn't put you to sleep. First of all, we all know that COVID happened, right? When that happened, the government shut everything down. Then they gave out a whole lot of money. Why? Because people couldn't go to work. They needed something to live on. So the government did do a lot of welfare-related type plans and rolled out tons of money into the system so that people could continue to live. Fast forward some period of time, and there was a vaccine that was rolled out, right? We all know that. As soon as that vaccine got rolled out, everything opened up really, really quickly. What happened then is demand spiked overnight. The best analogy I can do here is a light switch, right? When you leave the house in the morning, you turn off the light. You come back, you flip the light on. When you flip that light on, you expect that light switch to come on. And it does in your house. But in the real world, when you're talking about all of the demand for all the goods and services that we needed, remember, we were shut down. The supply chain doesn't have a light switch. It is a very slow process to get it to catch up. So that supply chain needed to catch up. Because of that, we had massive demand and really low supply. That means inflation spiked, because that's in a capitalist society. That's how we deal with price. and demand inequalities. We raise price because there's more demand than price or than supply. So inflation had to spike. It just did. That's what happened. The Federal Reserve then said, whoa, wait a minute. We have two jobs here. One is to keep full employment, but two, we can't let inflation get out of control. They thought it was transitory for a while. And then they threw in they waved the white flag and say, all right, we got to raise interest rates because this inflation does not appear to be transitory. So they raised interest rates, but they did it really fast. Now, what I put on the slide here is a little illustration of just how fast it really happened. SOFR is an overnight financing rate that we use, that the banking industry uses to price variable rate loans in our world. In February of 22, it was 0.05%. That's practically zero. That same exact rate today is 4.55%. So in the matter of 12 months, we had a 450 basis points move in rates. I want you to think about the effect that would have on a $10 million loan. That means interest expense increased by $450,000 a year. And imagine a $20 million loan, a $30 million loan, the numbers just get obscene, right? So it was really, it really had a huge impact. That interest rate volatility created massive amounts of uncertainty. Buyers had to stop buying. Lenders stopped lending. Lenders stopped lending because they were scared. They didn't know what the hell was going to happen next. Buyers stopped buying because if you understand the transaction process, if I were to go in and buy a property and put it under contract today, not like your home, when you apply for your home mortgage, you get to lock the rate that day. Not true in the commercial world. That rate floats until you close. So now you have a $20 million loan sitting there that you're trying to process, and rates were moving around like crazy on us. And we couldn't afford to wait to let that thing float for 60, 75 days while we were trying to close this deal. It could have such a massive impact on the cash flow of the property. There was just no way as a buyer you could go out and confidently say, I can pay X for this property and know that I can afford to pay the loan. So that is why buyers stop buying. Lenders stop because they don't like uncertainty. So they stopped lending. They shut their doors and said, whoa, wait a minute. We got to figure out what's going to happen here. So those higher interest rates meant higher cap rates as well. And then, of course, a fear of a recession, right? Because now we're worried that nobody can buy their homes, nobody can buy cars, blah, 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 all the bad things that tend to happen when you have much higher interest rates. When cap rates went up, everybody still with me? We still good? Give me a little bit in the chat if you don't mind. Say, yes, I'm good. Do something, all right? I got to know you guys are awake, please. All right, cool. All right. Goals, all right. See your question here. So stand by if you don't mind. All right. So cap rates went up. That means buyer and interest rates went up. So buyers couldn't pay as much. But the sellers still wanted to sell, but they wanted to sell based on yesterday's prices, last year's prices, 2 years ago prices. So sellers wanted so much more than buyers could afford to pay. Deal flow stopped almost immediately. And that's what happened. Everything shut down. Literally, the brokers went on vacation from about the 1st of November until NMHC, which happened just last week. They absolutely left. They shut down and just went on vacation. Now, the good news is inflation is coming down now. The Federal Reserve seems like they're close to raising rates. That makes me happy. Stability is returning to the credit markets. That makes me happy. Fear of a major recession seems to be receding. And we're not going to just take my word for it. We're going to talk about some third-party evidence here in a second. So what does all this mean? A lot of people bought properties at super low cap rates 2-3 years ago. Some of those people use longer-term debt and rate protection. That's good for them. They did the right thing. They are fairly safe. Many people bought those deals using bridge loans based on the assumption that they were going to get to move rents really fast and they would make tons of money. That's short-term debt. It's always written on a variable rate. Some people use rate caps to protect themselves for various time periods, but some people don't even have rate caps in place. Those people, I will tell you, are freaking out. That's why I put 3 crying faces up there. They are freaking out because like I said, the rate 4.5% rate movement is massive in this world. So as a result of this, some of the sellers out there are going to be distressed between now and the end of the year. Some of them are stressed right now because those variable rates cause higher interest expense. They may have expiring rate caps that maybe it was holding their rate at 2 or 3%, and now it's going to go to 7. So it matters. Property cash flows may not have increased enough to support the new debt service, right? It sounds like if you're that situation, I mean, you could be really, really stressed out. Fair? All right, so the result, some owners are going to be able to refinance because they moved their cash flow enough that they can afford new debt service. Good for them. They were disciplined, they did the right things, and were careful about what they bought. Some owners are going to have to sell to solve their debt problem. There's nothing wrong with the property. It's the debt that's in place. They can no longer afford to pay that debt. Some owners are going to have to sell at a loss to solve that debt problem. Okay. And then finally, there's going to be some non-distressed sellers who they're just going to hold on and wait for rates to come down. How can they do that? Because they've got longer term loans in place, and the fluctuation in rates doesn't affect them because they had a fixed rate. So where do I think we are now? There is still some debate on whether or not we're going to hit a hard or soft landing. Only time will tell. I'm going to give you some third-party evidence here in a minute. I don't think interest rates are likely going to return to pre-COVID levels just for a little while. It's going to take a while for that to happen. Therefore, higher cap rates are probably here to stay for at least a little while. The good news is, and this is huge for me and for us as buyers, the stability in rates does make it possible to do deals. Now, if you'll allow me, I want to share with you, I am a huge proponent of very important information coming from third parties who are non-political, who are non-salesmen, that are going to give me the real deal. So I spend a lot of time and energy following what economists say. Now, economists aren't the end all, but they're objective, and that's what I care about. They give me data. So I subscribe to ITR Economics. I would encourage you, if you care about this stuff, they have some pretty good subscriptions. I'm not here to sell their subscriptions, but it helps me a lot understand what's happening in the market. I just want to share a couple of excerpts with you. So this is from their January 23 report that I get. Their long-term view is 23. So this is the value that I'm hoping to bring to you guys tonight, an objective view on what's happening in the economy. Slowing growth for 23. They're expecting some level of a recession in 24 and a recovery in 25. That's what they're expecting right now. Let me just go through the highlights here. So that's the January report. You can see it in the top right corner. Inflation. Boy, I might care about that, right? Now I'm reading from the report. We are forecasting inflation to average 3.6% for 2023, dipping back to the 2% range in the second half of the year. Wow, that's awesome, right? That projection was made less than 30 days ago. It was made before Powell's last, the FOMC's meeting. So it's a little bit dated, I guess you could say. The February report hasn't come out yet, but I do have some information tonight I'll share with you on the February report. Interest rates. Do you think I might care about those? I probably would. U.S. short-term interest rates, as set by the Federal Reserve, will cease their rise around March to May. That seems to be consistent with what I think might happen. Long-term, this is huge for us. Long-term interest rates are likely to move generally lower in 23, with more pronounced decline in the second half of the year. Boy, isn't that valuable information if you're trying to figure out whether or not you can wait out a rate cap expiration or something like that. So that's what they said in 23. Here's the report I got just this morning, and I wanted to bring it into this presentation, hoping that you would consider it to be valuable. I'm not going to get into details here. All I want you to do is pay attention to the colors. In their world, a yellow means slowing growth. So this is the 12-month moving average. This is what they expect through the end of 23, which is consistent with what they said in January. They're expecting slower growth. Red, as you can well guess, means recession, but not all aspects of the economy. They expect some of the economy to be in a recession. And almost across the board, they're expecting green is good, is what we would expect. So it is still consistent. They're expecting some good growth in 2025. So a little excerpt from this morning's report. We expect the decline to be relatively mild compared to historic cycles. It will be akin to the early 90s or the early 2000s recessionary cycles. See, I view that as really good news for just about everybody. Real GDP will rise in the first half of this year and then flatten out in the second half of the year. Decline is expected during a portion of 2024, which is exactly what they're projecting up here. I don't know if you find that valuable. To me, that gives me massive value in terms of where we think we're headed. All right, we're almost through this, so let me try to wrap up for you. All right. So on the ground, the real deal here at KRI, I think the business execution continues to be critical to the success of these properties. I have always held that, and when things get a little tight, it just reaffirms it every single time I go through a cycle. The status of our properties, I'm proud to report we are doing very well. All of our owned properties are at 95% or higher. Delinquencies continue to be low. Even our Bradenton deal, which was a very heavy lift, we did a lot of work to turn that property around. We are pre-leased to 97% at that property. I just did a report earlier for our Google AdWords guy who wanted to take a look at it. Since November 1 to now, that property has like 1,900 leads that it has gotten for apartment rentals. I mean, that's just a staggering number. Just gives you good feel for how much demand is in those markets. Rents continue to remain strong. So far, I'm not seeing any retracement in any of the properties that we own, and we don't currently have any concessions in place. All right, our debt, right? I spent a lot of time talking about debt and interest rates. What about our deals? Are we okay? So we have long-term rate protection in most of our deals. We are, and I'm going to say might refinance one. Please don't interpret that as will or more likely than not. We are just looking at this right now. We might refinance one of them, only to extend our rate protection, and we might be able to actually reduce our interest rate compared to the bridge loan that we have in place, and reap the benefits of a rate cap that we originally paid $40,000 for, that is valued today at $313,000. We would actually get the benefit of that, the gain from selling that to someone else. So I'm looking at it. We're a long ways out from making a decision, but this is the real deal. I promise that's what I would give you here on this call. We might refinance another one. This is another deal. If we do that, we just have massive, massive equity in this deal. We might just return everybody's capital. We're probably going to return all their capital and then some, and they will continue to get huge cash flow. They will have nothing in the deal and probably gotten not just 100% of their capital back, but probably 110, 120% of their capital back. Plus they're getting cash flow from that. So that's where our debt position is. I feel very comfortable with that. Again, observations. I go back to, I've always said that investing with experienced operators and people in this business is more important. It has always been important. It just shows right now why it's more important than ever. Our investment thesis, I get challenged on our investment thesis all the time from people trying to get into this business. It is extremely disciplined. It's deliberate. I almost view it as rules. We buy apartment communities in growing areas in good neighborhoods that when we physically improve them, management-wise and physically improve them, we can make them a lot more valuable. And it's because we are able to significantly improve the cash flow of the deal. That is the people that have been able to improve cash flow, they're able to earn their way out of most debt problems. If they bought marginal deals that didn't have the upside, those guys are struggling right now if they aren't properly protected. And again, I'll go back to our fund. I just want to remind you, we are definitely here to raise money and wrap up fundraising for our second fund. I've given you a lot about what our funds have been able to do. If you want, and I didn't put it in the slide, probably my bad, Our entire track record, if you scan that QR code, our entire track record is right there for you to see. It's on Veravest. It's been vetted by Veravest. So you don't just have to take my word for it that we've done well in the past. Somebody else has looked under the hood, pulled back the curtain, and really vetted us in a huge way. So I always get the question, what do you do? All you got to do is reach out to us, have an investment call with us. It will be either with Max, Sherry, or myself. We're going to spend time on that call talking about your situation, what you're trying to do, because it is more important to me that we have a good match between your goals and our goals, what I think our funds can deliver, so that we can put you in the right place. That's what, that's what that call's about. We do insist on talking to every investor before we let you into the fund, because it's that important to us. I'm here to tell you that whether you have, $100,000, $500,000, $5 million, I'm pretty sure our funds can help you reach your financial goals. I want to revisit our questions that I promised you that I would answer. First of all, why higher cap rates and interest rates are actually good for you as an investor. Let me make sure that's clear. Right now, cap rates are higher, interest rates are higher. That means we can only afford to pay a little bit less than before for a property. If we are able to buy a property now, especially if it's distressed and we get a good deal and cap rates reduce because interest rates go down, that puts the wind of our back even better than it is if we're already in our demand supply imbalance. So higher cap rates and higher interest rates are awesome for us to go buy that deal, because then when we sell, the situation will likely be so much better. Why is no one selling right now? And when I think they will sell, I think I beat that one up pretty good. We know why no one's selling, and we know when they will sell. I think I covered that. Why some properties are performing really well and some aren't. And I go back to, I think I talked about it. This is about execution on your business plan. It's about paying attention to the details and making sure that you have a good operations team to run your properties. That's really, really important. Should you invest now or should you wait? Look, here's what I'll tell you. I always tell people the worst advice you can get is an advice from a sales guy, right? Well, I'm not a sales guy. I'm going to invest right alongside you. So I am not afraid at all to put my own personal money at risk. And, I would just invite you to do it with me. All right, Max, do we have any, thank you, Doug, I'll tell Sherry you said that. Thank you. Okay, Rhea, let me cover a couple of these in the chat. What does retracement mean? So when I talk about there's been no retracement in rents, so a lot of people, you're hearing a lot of communication or a lot of talk in the media about rents were going up, but now with the recession, all of a sudden rents are falling back. They're going down. Going down would be that retracement, and we're not seeing it at our properties. Now, I'm not saying that it's not happening at other properties or some other markets might be, but remember, we so require our demand to be so much higher than our supply in our demand supply equation in the market that we're operating in, that it makes it hard for that retracement to happen. It would take a really hard recession to make rents go down in our market. So that's a good question. Do you think that there's enough rescue capital on the sidelines that will come in at a preferred position, will be expensive, but so they won't have to sell? Donna, so I think, let me just make sure I understand your question. What I think you're asking is there a way out for most people, either by selling their property? Donna, is that where are you at, Donna? Can you raise your hand? I'd love to have a conversation with you. Oh, there you are. All right, unmute, kiddo. All right, there you go.
Hello. I would love your thoughts on it, because there's so many folks that are kind of sitting on the sidelines right now, sort of waiting to pounce on possibly all these opportunities that are going to come up. But then you just wonder if like all these preferred return funds are going to kind of insert themselves. It won't be fun for the people that own the properties, but they won't lose their positions. And so like, it's almost like, I don't know, you just wonder whether there'll be truly all these great opportunities or not.
Yeah, so that's a really good question. I'm not a guy that lives at the extremes. I mean, a lot of people are pounding their fist on the table. This is the best buying opportunity in the history of the world, the universe, the galaxy, whatever, right? And I guess you could say that, but there are going to be some distressed deals. There just are. And what happens over time is that market stability needed to happen, and it is happening. And we just need to see rates chill and just relax so that we can buy in a more controlled environment. And there's lots of buyers out there. Now, what's important is the deals that we will do, we're going to stick to our disciplined approach and make sure that if we buy a deal, it's going to be one that's going to make money. I'm not going to rely, hoping and praying, I hope the interest rates go down because then I can make money. That's not how we're going to buy. That's not how we've ever done it. And we won't do that. Is there a lot of rescue capital? Yeah, there's a lot. I will say, I didn't share this with you earlier, but I got a text from one of a very good, solid source of mine. He's a lender. And he said that last month, ready for this? You got to think about what I'm about to say. Last month, 80% of the CMBS deals that were done were cash in refinances. Now, what that means is they went to the CMBS market. They said, I want to refinance my property. They got the appraisal. They underwrote the property and they said, we'll do the loan, but your loan was 70 million before. We're only going to lend you 50. We'll do the loan, but you got to put in $20 million to pay off that old loan. That is a cash in refinance. You're not used to hearing that term. So what I'm telling you is there is a lot of problems out there, and the people that can, that have that, I used a big example of $20 million cash in refinance, but there are people that are able to fund those things, so they're okay, right? But the smaller you go, the lower you go in the totem pole, the much more thinly capitalized those assets are, and they won't be able to afford that. And that's when guys like, unfortunately, that's when guys like I come in with a fund already raised, and we're going to make a good deal and make it happen.
I got you. Thank you. That was very helpful.
You're welcome. All right. We like the emojis. All right, I'm just looking for questions here.
I've got a question.
Okay.
Bottom comment. It says, please describe the aims and goals of the current open fund.
Yeah, the aims and the goals of the current. So it is a rinse and repeat fund. When I say that, we are going to take the exact same business model that we have used for the last 25 years and continue to do it. We're going to look for value add deals in good neighborhoods that we know we can move rents and therefore make the property more valuable. That discipline, that model, that business thesis, investment thesis works all the time. Because we're so disciplined on it, we don't have any loans in trouble. And that makes me really happy. And I will tell you, there is zero chance that I was projecting a 450%, 50 basis point increase in rates. Nobody on the planet was expecting that. No one, nobody. So you can't even blame the guys and gals that are kind of caught in this, right? I'm just telling you, though, that I have been accused of being too conservative, but it's why you saw the returns that we've generated on the deals that we've turned. And some of the investors in this room, I know, have been in deals that we've turned. And these are the real deal. I mean, it's why, it's my job. You're gonna show your confidence in me, and I'm gonna do my damnedest to not let you down and make sure I hold the line on our rules so that I can put us in the best position to make money. Thanks, DJ. All right, any other questions? All right, so if anybody's interested in a replay, we will send it out. Let me know. I hope that at least a couple of you might be interested in our fund. Reach out to me or Matt. I have the QR code on my background. Just scan it. It'll get you there so that you can get on the horn with us. Okay, DJ, you registered for it. As long as you're registered for it, we have you what you need. All right. Are rents going down in your target locations? For example, the observers and prognosticators are saying rents are going down in Jacksonville. Yeah, first of all, I'm not in Jacksonville. It's going to depend on where in Jacksonville. This is where the market matters, the neighborhood matters, right? I like to be, if you look at a clock, I like to be between 3 o'clock and 6 o'clock in Jacksonville. That's just where I like to be. Bell Reef Club was right in the middle of that. And as long as you're in the better parts of any area with all these demand drivers, right? Diversified demand drivers, you're going to be okay. I'm sure there are parts of Jacksonville that are struggling. Here's what will happen. As guys, see, this happens every single cycle. The first thing is I know a cycle is happening because my property management phone starts ringing off the hook. Can you manage my property? Can you manage my property? Can you manage my property? The guy's not doing it well enough. See, when things are going up, it hides a lot of mistakes. It hides a lot of inefficiencies. But when things starting to tighten up, then those things are exposed. And it happens every single cycle. It's happening again. So what happens then is people are struggling with operations. So now because they're not operating the property well, they're not giving their people good service. The people leave. Now they got to fill the vacancies, but now they got a reputation issue. So now people have to lower the rents to get the people back. You see what happens? It starts to become a cycle, is what really happens in this. Now, are there markets that are declining? Yeah, probably. There are parts of Jacksonville, but I mean, you just study your neighborhood and make sure you don't find yourself in one of those neighborhoods. So we are not seeing it in Bradenton. We are not seeing it in Daytona. We are not seeing it in Tallahassee. And we're just super careful about where we're at to try to mitigate that risk. I mean, I told you 1,900 leads for Bradenton in 4 months. I mean, that's in 3 months is insane. I mean, that means you got a massive housing shortage there. Great question. All right, anything else? All right, guys, this has been awesome. I can't.
We got one more question.
Oh, yeah.
Court Olson in the chat. He said, missed the early part of the presentation. Are we looking outside of Florida?
Yes, excellent question. We are. We're holding the line on the rules, though. We are looking in the other growth markets outside. I'd love to come to the Carolinas. I like the Carolinas. We just got to make sure that we understand the market there, and we got to find a deal. So one of the challenges, I didn't talk about this, but one of the biggest challenges we're facing is deal flow. I mean, when the brokers go on vacation for 2 months, there's no deals, man. They went to NMHC out in Vegas. I think most of you know what that is. That's a huge national multi-housing conference that the brokers save all their listings for that. So they can go meet with all the buyers, and it is a whole deal. They literally went there and talked about nothing. They had no deals to talk about. None. I mean, I hear them complain to me every day. They're beside themselves. So deal flow is tight everywhere. So that's why I need to look outside of the state of Florida to find the good deals. And we're just going to be really careful and picky about that. Great question, Court. All right, what do you think about Phoenix, Texas? Lots of multifamily in progress there. Yeah. So DJ, let's talk. I want to, your question has a little, absorption, new inventory, overbuilding kind of connotation to it. So I think that might be where you're going with this, but I want to talk about it. And the reason I want to talk about it is, remember I said every part of our business plan is super deliberate. We buy B-class properties. So when areas like Florida, like Phoenix, like the Carolinas are growing, there's wealthy people moving into those areas, but most of those people moving in are not wealthy. They're ordinary people, just normal people that want a really nice place to live. Well, the builders are taking care of the wealthy people coming in because they can afford $3,000 and $4,000 a month rent. That's not the game we play. You see, most of the growth is in the B class. So that's why we stay there, that we stay where most of the people are. And so if they want to overbuild a little, if I get massive overbuilding, then I care. But builders always overbuild when there's growth. They just do. I don't know why they do it, but they do it every single cycle. And so what happens is, if it gets really, really overbuilt, they'll come down and try to take some of our tenants away. That happens a little bit. Usually doesn't last long because they can't really afford to function like that. But their rents are usually so much higher than mine that think about just a normal person needs a place to live, $3,000 a month, or they can live in a really nice property that isn't quite as nice, but it still has a pool and a tennis court and a fitness center and a business center and an Amazon locker and an outdoor TV, an outdoor grill. I mean, good Lord, what more do you need, right? They'll do that for $1,000 less all day long. So I like it when they build because then I use that to draft off of, and I manage that delta between the brand new stuff and what I'm charging. And what usually happens is they pull me up with them. because I'm not going to let that delta get to be 1,500, 2,000. I just don't. That would be silly. So I call it like it's a huge sucking sound that just brings everybody up with them. So that's a really good question, DJ. Very insightful. I like Phoenix. I like Texas. Houston, I'm not as huge a fan of, but I like it. It's okay. It's just rents don't move as much in Houston, or at least it doesn't seem to be. More work to be done there. Dallas is growing. Phoenix is growing. In fact, there's somebody on this call who's working hard to find us a deal in Phoenix. I don't know if he's still here. I saw him earlier. There he is. Yep, he's there. I won't call him out, but yeah, he's on this call right now. All right. Anything else, Max, that I missed?
Don't believe so.
We all good, guys? Wait, when rents are raised in the current properties, are the tenants staying or are others coming in? Great. All right. So, Court, let's talk about how we handle renewals. So let's use our Tallahassee example. We have people that were somewhere between anywhere from $300 under market to $700 under market. I mean, that's crazy money. And we know this because we did a rent survey. We shopped all the competitors. So on a renewal, we would typically recover half of what we call our loss to lease. So if you're $400 under market, we're going to raise your rent $200. And at first, they'll get a little stressed out. Well, what they do is they go looking around then and realize, oh, Jesus, I'm still getting a hell of a deal. I'm not moving. Okay. And they stay. Some do, right? Because some are really price sensitive, but most of the time, those people will stay. Okay. Then the second year, we're going to catch the rest of it up is typically what we would do. Now, if they do move, what do? We get the whole $400 because now we rent to a brand new person off the street. They know what the price is. It's completely painless. Nobody even notices it. Did that help you, Court? Hopefully it did. It's Gulzar, right? Okay, so Gulzar, what cap rates are buyers paying today for B-class properties? It is going to depend on the neighborhood, the area. I will tell you that right now, in most of the markets we're looking at, you're probably in the low fives, somewhere in the fives. What they don't want is to have something called negative leverage. Negative leverage is when you're buying, let's say you buy at a 5 cap, but your loan is 6%. Well, that's negative leverage. That doesn't mean you're actually going to lose money. That means that the lender's going to pretend half the deal at 6%. Your investors, they too want 6%, but there's not enough money there because you paid a 5 cap. So the investor just has to accept less. So what happens, that's the reason when rates go up, cap rates kind of come up with it. Now, here's the thing about really, really high demand areas like Florida. It doesn't move up basis point, point for point. It doesn't work like that. Why? Because Florida is growing so rapidly. So many people want to be in Florida that people will squeeze and say, you know what? I'm willing to wait for that return because I know it's going to come in a high growth market like Florida. All right. That's huge. That's huge for me. Now, in a weaker market, you'll get people that will, the cap rate, if rates go up 10 basis points, cap rates will move 20 or 30 basis points, right? Like I think about Cleveland. It doesn't have that demand supply setup that I love. So when interest rates go up, the cap rates not only went up to match, but they went up more because people now got stressed. And Cleveland turns back into, when there's a threat of a recession, Cleveland turns back into a cash flow only market that people only buy in it for the cash flow. And so now they're like, look, we're not going to accept a low cash flow now because we don't think we're going to get more appreciation. We need more. So the cap rates actually go up in those kind of markets. So a lot of stuff going on here. It goes back to, there's only so much you can digest. I mean, I think, sometimes I probably am guilty of oversupplying information. I'd rather have you be informed. Just know that that's our job, is to put all this stuff together and to do the best thing we can to mitigate all the risks. I mean, when you invest in the stock market, the number of risks that you take on there are even 10 times what they are in the apartment world. Anyway, hopefully all this information sharing that I've done has been helpful for you and not just, made you stress out about investing in apartments. I do apartments because I can't find a better low risk, high return setup. I just can't find it anywhere. And that's why I do it. That's why I don't like the stock market, because I don't like that risk setup. You're welcome, Rhea. All right, anything else? All right, I think we are good. Guys, thank you very much for your time. It is 8:03. I've kept you for an hour very valuable. Thank you for spending that time with me and with Max, and look forward to talking with you soon. And for those of you in our fund, I know you're on this call. I can see you. Thank you so much for your trust in us, and just know that I promise you, I am working very hard to find a deal. I'll give you an example. Last week, I made a quick trip to Florida, thought I had a deal in Orlando, turned out not, didn't like the neighborhood. So we are at a moment's notice, we could find that first deal. And I know the brokers, I'm working them hard right now. So they're trying to get us stuff. They just don't have anything. All right, guys, have a wonderful evening, and we'll talk to you soon.